are recommending. But we're also looking at ICICI Lombard and the Q4 numbers. I think the stock is under a bit of pressure right now. Surbhi is here to tell us more about that. Surbhi, over to you.
Thanks so much for that. So ICICI Lombard will be in focus today. That's because the earnings were a mixed bag. The GDPI, which is the gross direct premium income, missed estimates, but the PAT beat estimates, and that was largely due to higher investment income. The GDPI was up 7% on a year-on-year basis. The net earned premium was up 12% on a year-on-year basis. The combined ratio also remained elevated at 104%, which was in line with the estimates. The company continues to guide a combined ratio of 102% by FY25. The claims ratio was also higher than estimates, and that was due to higher claims ratio in the motor third-party portfolio. The management continued to remain cautious in the motor business given the competitive intensity. Now that, combined with the regulatory requirement of bringing down the stake of promoter entity ICICI Bank, continues to be an overhang for the stock. Brokerages also have a cautious view on this. Jefferies has a buy rating, but they've cut their target price to 1560. They say for FY24, you have to watch out for the rise in cost of reinsurance and also how industry adapts to the expense of management rule. They trim their estimates by 3 to 5%. They further say that the stake sale and the CEO succession may limit the re-rating of the stock. JP Morgan has a neutral rating, but they've cut their target price to 1160. They say the motor portfolio is likely to remain competitive, and the comprehensive product portfolio, which is PNC, may see lower profitability due to increase in reinsurance rates. They don't have the visibility to price in a beat of the management guidance of 102% of combined ratio by FY25. Additionally, Morgan Stanley has an overweight with a target price of 1400. UBS has a buy rating with a target price of 1445, and Nuvama is the lowest amongst all. It has a hold rating with a target price of 1200.
Surbhi, thanks very much for that. And you can catch the management of ICICI Lombard, Gopal Balachandran, CFO and Chief Risk Officer of the company, join us at 9:50 for a chat on the performance. So that's coming up later on the show. Now we're racing to the market open. SGX is, the pre-open is indicating an absolutely flattish kind of start. That's where rates have settled on the Nifty and the Sensex. But let's refocus on a few stocks. Titan is something we want to highlight once again. Mangalam, back to you.
Well, two reasons why Titan is in focus today. The first one is Kotak Institutional Equities has written that their interactions with some of the franchise owners and the industry suggest that the Titan management has gone ahead and cut incentives/commissions that they give to their franchisee owners by about 50 to 60 basis points or 100 basis points, depending on the nature of the franchise that it is. The impact of this could be a positive 50 basis points improvement in their margins over the next 2 years, and over and above that, the company has anyway been tightening the leash on costs itself. That's as far as the business is concerned. The second reason why I'm watching is, and more important from a stock market standpoint, remember when the Lenskart deal had happened where ADIA had invested in the company, we here at CNBC-TV18 had posed the question that will analysts now start ascribing value to Titan's eye care business, and that's exactly what has happened. CLSA has written, and they believe that their eye care business will go ahead and be a growth driver for the company, and they valued the eye care business, which was previously not valued by analysts, at $1.9 billion. So that's a big positive, as a result of which they've increased the target price on the Titan as well to about 3150 odd rupees.
Okay, all right, Mangalam, thanks a lot for that. Well, I'm focusing on Coal India. JP Morgan, they have been positive on Coal India, and they retain their overweight stance. They've increased their target price to around 290 from around 285 earlier. They're expecting the long-awaited FSA price hike to come about. Given that the wage hike has happened, now the street is focusing on FSA price hike as well. Keep in mind that the last hike was in January 2018, so it's been a long time since we've seen the last hike. If, in fact, they can report stable earnings or maybe higher than expected earnings, then it will lead to higher dividends. And finally, they point out that the FIs, they have been a little bit skeptical on the stock, but now they've increased their holding, telling you that ESG discount is now behind, and it appears they're looking ahead, given that they've increased their holding by around 1.3% odd. Made it in time.
All right, made it in time for an opening that's going to be really flat, right? I mean, not too much expected anyway.